Good afternoon. Friday afternoon, kind of a rugged week and a rugged day today. The market was down 665 points, and I'm sure people are wondering why. There are a lot of answers, but one certain answer is that interest rates have sharply moved upward. And the fear when rates move upward is that they're moving upward because the supply of money is being lessened in the economy at the same time that the Federal Reserve is considering raising interest rates as well as normalizing, which means getting paid off on the debt that had accumulated through QE 1, 2, 3, 4, and they're going to leave that money out of the economy. So the fear is that the economy runs out of fuel, and then a recession, and then bad earnings, et cetera, and that's the general gist. They're black swans, in addition to that, flying all over the place. The memo that was issued today out of Congress, the whole political thing about Trump and the investigation, and then we've got the geopolitical problems out. They're all black swans. We can't analyze them. They're out there. But this market primarily is moving down for fears of higher interest rates and secondarily fears that a budget fiasco continues down the road and the military doesn't get funded. And so that's the bad side. We disagree, frankly, with the market's assessment of money. And we think that a lot of analysts and strategists are overlooking or even not looking at some of the monetary aggregates. But the monetary base in this country, which is all money in circulation in checking accounts, all the dollars that are out there, is somewhere around 5 trillion, I should say. Over 50% of that money is in the form of excess bank reserves, meaning that the banks have put away more than they're required to put away by approximately $2 to $3 trillion over the last 4 years or so, while the Federal Reserve was lowering interest rates and pumping money into the economy. Well, our banks saved it. And if we need that money put back into loans, then it would multiply through our multiplier system, where one bank takes a deposit, keeps 10%, loans out 90% of that deposit, and it keeps getting loaned out on the same dollar. It could, on the high side, create another $20 trillion of capital to be used in our economy. I don't think it's all going to be loaned out and it's all going to work that way, but there's plenty of money to go around, and this is why we differ. Today there was news of a 5% growth rate in the economy for the first quarter. This was brought on by the Atlanta Federal Reserve, and that's very positive. But then again, we're in a realm where good news is bad news. People look at a high economic return and say, oh my, that means the Federal Reserve is going to raise rates sharply. As a result of it, the economy is overheating. It's not overheating. It's simply trying to catch up for what it lost in the last 10 years. So our view is fundamentally very different than the market view. We're still very positive. Nevertheless, we promise to protect assets, and we have our disciplines and our sell points. So this morning early, we cut back some more, took some more profits off the table and parked the cash. So the firm is currently, on average, the firm's in a neutral position, not even leaning positively. We're still in there, but we have to exercise our technical disciplines to try to protect capital and make the proper risk adjustments. Volatility should be expected. Don't lose sleep over this. After all, the market did run up thousands of points since the election, and this year alone ran up a lot. So we're simply correcting some of that, getting back to a much more normalized rate of growth that we should all benefit from. So these are just little rocky points on the road, and I hope it doesn't ruin your weekend. You have a good weekend, and we'll be at the switch on your behalf Monday morning. Thank you.